Hello and welcome to Switzer Investing TV. I'm Peter Switzer. Thanks for joining us. On tonight's program, I've got Adam Dawes of Shaw and Partners. I'm going to ask him about a number of stocks that have been doing well and those that have been pretty well smacked last week on the market. They include Paladin, A2M, Pinnacle, IDP Education, Nuron Pharmaceuticals. And I also want to talk to him about lithium stocks as well as CBA getting to $160. And then I'm going to look at a big story about Warren Buffett doubling his cash holdings, which is spooking a number of people, particularly with our markets at record high. I'll do an in-depth look at that story about Buffett increasing his cash holdings and whether you really should be spooked by it all. So let's kick off now with Adam Dawes of Shaw and Partners. Well, joining us now, as I said to you in the intro, is Adam Dawes of Shaw and Partners. How are you, Adam?
I'm very well, thank you, Peter. How about yourself?
Very good. We are happy to see that the market had a nice, strong day today.
Yeah, and I even watched CBA open up at $160 even, and then smartly get sold off back down to $158.50, and now going back towards 160 again. It seems to be unstoppable at the moment.
What would you do if you're a big holder of CBA shares? Looking at what the analysts are saying, they're all saying, like I think the average of the analysts on FN Arena says about a 35% fall for CBA.
Yeah.
It seems too big to believe, but I'm thinking a 10 or 15% pullback makes sense. But yeah, does CBA defy sense?
Well, it already has, and I think you know the most of the broking community, as you say, are at sort of most brokers have got to sell on the stock. I think that overall, it is such a massive part of the index. It's really hard to ignore the amount of money that is flowing into this thing, going forward. If I had largest amounts of CBA, I would definitely be trimming some up here. My cost base is still going to be fairly low, so you have to be mindful of that cost base. But I'd definitely be trimming some here. I think, but look, even if it falls 20%, let's say it falls by $20, most people are going to have their cost bases under the $100 mark or 100, so it's really not going to affect them too much. But if I had a very large holding in it, I would definitely be trimming some. That's for sure.
Yeah. I think that makes sense, but tell you what, markets, what's the old saying? A market can be irrational longer. Remain liquid.
Well, that's exactly right.
Yeah.
And I think we're seeing that at the moment because, a lot of people sold out of their CBAs at 130 thinking it was too expensive, 140 it's too expensive, 150 it's too expensive. Now we're at 160 and, so yeah, it's a really tough one because I've given up on trying to get clients to sell CBA. It just doesn't work. They're just like, no, we're going to hold it. So it's a very tough one.
Okay, well, you're doing your job, and end of the day, client gets to choose what the client wants to do.
Exactly.
Okay. Let's have a look at a number of stocks, and I've pulled these stocks out on the basis of what happened last week. And most of these have done well. Some have been challenged. And my question is, have they been oversold and therefore they're buys? Let's kick off with Paladin. I think it was smashed the week before last and was back in favour last week. What's the house view on Paladin?
Well, the house view is that we've got a buy on Paladin. The house view is that we're very bullish uranium. And it will continue. Uranium will continue to move higher. There's sort of no doubt about that. But what's happened with production within Paladin, and they revised their guidance down. They were looking for sort of 4 million pounds. They've guided that down. Sorry, they were looking for 3.8 to 4 million pounds. Now they've guided that down to 3 million pounds. So that's a downgrade in anyone's language, and that is really sort of hurt Paladin, and potentially it was the coal and the canary mine as well, because we've now started to see production cuts from some of the other larger uranium producers also. So look, the stock declined around about sort of 30 or 28.9% post their announcement in the investor briefing. And really that was those ongoing issues with stockpiling and processing and the variability of that ore grade that Paladin had. So they had to put that downgrade in there. So I think that bad news is out of it, or is into the market. That stock has been readjusted, but we are very bullish on uranium, and hence why we're sticking with a buy with Paladin.
Okay. One thing I have to bring up before I look at what the analysts are saying about Paladin is that you're the first person ever to say that there was coal in a canary mine.
You knew what I meant. Canary in the coal mine. I saw your face and I thought, oh, damn it, I've said something wrong there. I said it.
Yeah.
I know.
Yeah,
But yes, you're right. Well picked up. It's the canary in the coal mine. Or the canary in the uranium mine. How's that sound?
Okay, fair enough. All right, so the consensus view on FN Arena is a 47.3% rise, and you've got 4 out of 4 analysts liking the company, and your partners, Nuron Partners, has an 88.77% buy rating on it. So
Yes.
certainly you're true to your organization's belief on uranium. And I think a lot of people have this view that because Australia is anti-uranium legislation-wise, they think that that's the view of the rest of the world. And it's certainly not the view of the rest of the world.
Yeah, and I think when you've got the likes of Yahoo, Microsoft talking about these SMRs, which are the small medium reactors, which is basically, Microsoft is saying we need this energy, we need this power, and we need it to be clean, but we can't wait for governments to come through and to make it, make it work, make it process. We're going to have to do it ourselves. And that's a real key issue for the uranium sector, is that you've got big businesses now looking to use, because they've got so much need for power and they have to do something about it, and they're doing it themselves. That's a real boost of confidence for the whole entire uranium sector.
That's right. And those companies are afraid of being associated with fossil fuels because a large chunk of their customer base are very much supportive of alternative energy.
Yeah, agree.
Okay. Let's go to another one that's really been a disappointing stock for a long time. Had a good week. A2 Milk. Where are we with A2 Milk? Is this just a flash in the pan, and we can expect to be creamed again by the management of A2 Milk?
Well, I think A2 Milk is milking modest upgrades. So you came to the party, I came to the party.
Yeah.
So look, overall, I think A2 Milk provides. Look, they provided their update at the AGM, and the stock definitely popped after that trading update at the AGM. They basically, and it's what's prompted a lot of the analysts to sort of upgrade their numbers near term, not longer term, but near term. Those markets looking to bring that higher. They've basically said that they're going to revise their sales by 2 to 3% across the period, or upside. And that means that adjusted a PE ratio of around 23 to 22 times. So it does look a little bit better and a little bit more aligned with more of a sustainable growth going forward. I think broadly speaking, A2 Milk has definitely been in the sin bin for a long time now, and still struggling to find its feet, whether it's infant formula, milk, all these kinds of things. I think they're still struggling a little bit, but it's really nice to see just a little bit of a revised upgrade to that. And I think that goes a long way to shoring this company up for the market to be a little bit more confident moving into 25, 26 and 27. Yeah.
Well, looking at the consensus view, mate, it's about 10.1% upside, and the most enthusiastic is Citi. Citi have about 27% upside call on A2 Milk, so they're the biggest supporter. Most others range from 11 down to about 1%. So, yeah, I think they're pretty well on board with what you're saying. Positivity, but not excessive positivity. Let's go to a company that keeps on confounding its critics, and it probably doesn't have many critics, namely Pinnacle.
Yeah.
How come they've done so well?
Unbelievable, hey? You look at that chart and it looks absolutely gorgeous.
Mm.
Look, there's a couple of things. They've got around about $42 billion worth of international funds under management, and that was September 30. So a little bit retrospectively looking there, but something like that. And then, overall, they've got 25 billion in private fund markets or private markets as well. So I think that they're seeing positive first quarter net inflows. Remember, you want to be in a business, if you're in funds management, to see those inflows coming through. And they're seeking to expand internationally. They just raised $400 million at $20.30, and the share price is $23.70 today. So again, that shows a lot of confidence for that 400 million. And they've just bought bought two funds management businesses for 142 million Aussie, which then obviously will keep that EPS, earnings per share, moving and growth going forward. I think it's a combination of inflows, which is doing very well. Some of their products have actually doing very, very well as well. HYGG is the Hyperion Global Growth that's listed on the Australian Stock Exchange, but it's also a funds management business that's doing very, very well. We're getting a lot of inflows into that. So Pinnacle's just got that right asset mix. It's a bit like Macquarie. You want to buy the mother stock, which is Pinnacle, because if any of these funds underneath it make some cash, they have to pay performance fees into the mothership, as it were. And P&I is definitely taking advantage of that at the moment.
I guess looking at what the analysts are saying, they think there could be a 5% fall, which of course is meaningless in the guesswork world of analysts. But I will say 3 out of the 4 see about a 10% downside. But that's only because this company is effectively priced to perfection. And I'm sure a lot of people have rushed into it because it has really confounded the market with its success.
Well, yeah, you saw on Friday, GQG, another fund manager that's had some fantastic results as well, but got hit with Adani and some of those bribery allegations. About 6% of their portfolio is with Adani. I actually, personally bought some on Friday. I think that's a very good fund manager, good inflows. Certainly not hitting the light or not shooting the lights out like Pinnacle. But again, you're taking advantage of these price mishaps in the market to your advantage.
Yeah, good point. So what you're basically saying that Pinnacle is a good company to buy on the dip. I guess on that point, what's your view on the likelihood of a pullback, given the unbelievable rise of the US market, and we've been a beneficiary of that US market? Are you talking to your clients about the possibility of a pullback, and what would you be recommending in terms of overall strategy if there was a pullback?
Yeah, so obviously the first thing in any pullback is going to be the financials, because they've just had such an amazing run. So you're going to see them get hit hard first. And then obviously the resource sector has been undervalued, underweighted, and there would be a rotation, I suspect, into that materials sector for another leg up. I think everybody should be mindful of their overall portfolio and making sure that it's not out of weight via asset allocation, or making sure that some of the profits that you do have, if you've doubled your money in a stock, why wouldn't you take out your original investment? If you've tripled your money in your stock, why wouldn't you do some kind of trimming just to make sure that you're preserving capital? And I think preservation of capital is number one in everybody's mind going forward. So I think, overall, you would look to just lighten a bit, especially in the financial space. You'd lighten a bit there. You could rotate in some of the healthcare stocks that have been underperforming. There's plenty there. Then obviously the tech sector is still running very hot. And remember, we don't know it's a bubble until it's popped. And at the moment, I feel that tech sector is looking like not a bubble. Don't quote me on it being a bubble, but I do feel that it looks like it's overbought at the moment in some places.
Yeah. On that subject, I totally agree when we talk about big tech in the US. And of course, big tech here as well. Every time big tech rise, we see the likes of NextDC and Zero do fantastically well. But a lot of other tech companies, smaller tech, haven't done well in the US and haven't done well here. So are you talking primarily about the whole tech sector or the big movers in the tech sector?
Yeah, the big movers, Zero at 170. 360 came off a little bit the other day. I bought some of that for a couple of clients. I think, taking advantage of that. I think WiseTech has now lost its market darling status, and it's going to get more and more difficult. So potentially I've started to talk to clients about reducing some of that WiseTech position. So yeah, it'd generally be in the bigger end of the town. The small end is still potentially struggling because they're probably not making any revenue. And that was the biggest thing 6 months ago. It was a tech stock that made money, buy it, right? Or made revenue, buy it. So I think, yeah, you got to look at that a little bit objectively going forward, but definitely in the big space would be
So
better.
you're really saying look objectively and selectively on the basis.
And selectively.
Yeah.
Yes.
Because there are going to be lots of businesses that will benefit when we eventually get interest rate cuts in this country.
Correct.
And some of them will be tech. Some of the small tech companies will debt. Let's go to a company that, I think it's been confounding lots of the analysts, namely in IDP Education.
Yeah.
What do you think's going on there, mate?
I mean, we've just been talking about stocks with charts going from bottom left to top right. Now we're talking about a stock that's going the exact opposite. Look, I struggle with this one. I really do. Overall, it is the most. It's the third most shorted stock on the ASX. It's got about 13% of its register, or 40 million shares, that is in shortest hands at the moment. And I suspect that they're continuing to build that position up. I think it has certainly risen the ranks over time. I'm just a little bit cautious. Overall, COVID, it got hit. I mean, there were so many things that have gone wrong with this business, albeit that it is a very good business because it does teach English, it's visas, it's international students coming through. It's all of these things. But yeah, you just look at that chart and you would not go anywhere near it at the moment. So I think that shorting position is going to get larger, and I think that the stock will continue to fall. So it's a really tough space at the moment, and certainly, again, was a market darling as well. Couldn't do anything wrong. But this year, in the last 12 months, it has certainly captured a lot of people's attention to see that there's value there. But I'd be careful with that value at the moment. I don't see that fall. I don't see that stopping anytime soon, that fall.
Yeah. You've got a 47% average rise from analysts, 4 out of 4 like it. Macquarie sees 29% upside, Morgan Stanley 73. But the bottom line is, they're facing the headwinds of both the government and the coalition not being great supporters of foreign students, with an election coming up in May. It's a hard one, but I guess, as you say, it's a very good business, but gee, it's got some headwinds, and I think that explains why it's so heavily shorted.
And you just look at the chart, there's no sort of reprieve, there's no sideways movement, there's no sort of building a base. It's just this sort of continual slide to go down, and it just, you wouldn't be putting fresh money in there at the moment, that's for sure.
Yeah. Let's go to a company I haven't known much about until one of our subscribers to the Boom Doom Zoom webinar, which you've occasionally starred in,
Yes.
brought up Nuron Pharmaceuticals, and it was really smacked last week, but it's had some pretty strong rises ahead of that smacking.
Yeah.
Do you have any view on Nuron Pharmaceuticals?
Yeah, so this is a business that looks at incurable diseases. Right, so Rett syndrome is one of those ones where it's very, very difficult to find a cure. And Nuron Pharmaceuticals is one of those businesses that looks to be doing quite well in that space. We have seen all of the healthcare stocks, especially CSL, those kinds of businesses getting hit on the back of what is happening overseas with RFK, Robert Kennedy Jr., and his stance on certainly some things like vaccines. We've also saw dental supply businesses going through the roof because he's going to take fluoride out of the water, and over time there's going to need more dentists because of that. So there's this sort of cause and effect that's happening at the moment. I think that the last it did an upgrade, and then it's now come back down to sort of where it started again. I think that this probably doesn't look too bad. It's risky. I don't think that RFK is going to muck around with this one because there's so much structure around incurable diseases. I don't think so. And so I think this one looks interesting on the back of that they won't be mucking around with vaccines or anything like that with this business. With this business. So it looks interesting. I need to do some more work on the biotech. I need to understand it. I need to see if they're cash flow positive. I don't know that yet. So someone's going to remind us after they watch this. But that's something that obviously we want to make sure that we're going for. So yeah, this one looks interesting. It's had a rise, come back. I think it's at some good support levels here. So I might start looking at putting that into some of the clients' portfolios, but only smalls at the moment.
Yeah, it's an interesting one, and as you say, it may well not be. I think the market did a blanket sell-off of any stock that they thought could be threatened by the new health czar in the US under the Donald Trump administration. But there could be value. I'm with you. I haven't got enough info on it, but it's an interesting one.
Yeah, I wouldn't mind talking about it next week as well. Or sorry, in 2 weeks' time, and we can do a little bit more of a deeper dive. So I've got some more info.
Yeah, good. Let's end up on on a question that many people would have, and namely lithium stocks. And before I get your view, I was intrigued to see that Albemarle, the US company, I don't know if that's the right pronunciation, that was courting and had a big share of Liontown and wanted more, and Gina Reinhart competed with them at a $3 level for Liontown, and then when Albemarle pulled out, the share price really fell. Albemarle got a big thumbs up from US analysts a couple of weeks ago, and I was just intrigued to see whether there's any positive signs for other lithium stocks.
Well, what the positive bit is, and just I'll overlay this, I think the lithium is a 2026 story. Okay, put it out there. That's where it needs. That's where it's going to start. The positive thing of what we've seen over the last 6 months is we've started to see Pilbara, all of these other businesses starting to shutter some of the mines because it's care and maintenance or they're non-profitable at the moment because where the lithium price is. What that does is that curtails supply, but demand is still there. We know demand for batteries. We know the demand, and everything's there. The lithium price is in the toilet at the moment because there's excess supply. If you take some of that supply out, you tighten that up, and you keep the demand going. Supply versus demand says that the price should start to rise, and we're starting to see that a little bit now with companies bringing mines offline and pulling them away. I think it's a 2026 story. I don't think you need to be rushing into this at all. There still needs to be more supply coming out of the market, but we do know Rio with LTM or they're taking that one over. Arcadian Lithium. There's a bit of corporate work going on in there, and I think the big businesses are smart enough to see these things and take advantage of when prices are depressed. But I don't think you need to be rushing into the sector. It is a 2026 story all day long at the moment.
And it's interesting when you think about the Trump threat to alternative energy. On the other hand, he's got a very close political buddy nowadays called Elon Musk, who clearly has a vested interest in not only electric vehicles, but he also has a pretty big investment in some of the lithium mines as well.
Agree. So you'd think that would play out one way or another, but yeah, it's we've got to get supply. We've got to stop that flooding of that stuff on the market, and that should make things a little bit more equal, create tension, and things should move from there.
Yep. So it's a real speculative play. Looking at the analysts, mate, 4 out of 6 are in the red. Mike Morgan's 2.56%, but Bell Potter, they're excitable boys, 79% upside. But the point is, it may well take a couple of years for it to happen, but when it does happen, they'll probably be right.
Yeah, agree.
All right, mate. Thanks for joining us as always, and I'll send you off with your homework on Nuron Pharmaceuticals. But I'll give you a distinction today for your work. No,
Well, it's good.
that coal in the canary mine knocked you from a high distinction to a distinction.
I know. You're right. You're right. All right, mate. Take care. We'll talk soon.
Cheers, mate.
Thanks.
As outdoors, offshore, and partners. And that was Adam Dawes Offshore and Partners. Now, I'd like to give you a little bit of an analysis, which I did in much more detail in the Switzer report. And it's a relevant question that I'm getting from lots of people right now. And that is, should I be nervous about the record highs we're seeing in the stock market, both in the US and here? And in recent times, a lot of people have been a bit spooked by the knowledge that the Oracle of Omaha, Warren Buffett, and his Berkshire Hathaway investment vehicle are holding $325 billion in cash. That's US dollars, which is reportedly double the amount it had at the end of 2024. So is this a sign that we should take to tread warily with the stock market, as I said, at a record high? And for the record, the S&P 500 ended Friday at 5,694 and is now up 30.93% for the past 12 months and 66% since the low in October 2022. The market fell from 5,766 late in 2021 to 3,583 after the Fed started its rate rise cycle. A lot of companies copped it when interest rates were rising. That was a bear market with a 22% plus side fall for the best index to measure the US share market, namely the S&P 500 index. Now, we've seen huge gains over a 10-year period of around 188%. Now, that is 18.8% per annum, and that defies the history of the US stock market. Over the same time, the S&P 500 equal weighted index was up 130%, or 13%, which is much closer to the average rise of the stock market over a decade of about 10% per annum. Still, are the gains historically high? And they are historically high, but we have been living through historically unique times. And the S&P 500 has lived through exceptional times as well, with that 18.8% gain per annum. But it's been overdriven or forced along by the magnificent 7 tech stocks, namely Alphabet, Amazon, Apple, Meta Platforms, Microsoft, Nvidia, and Tesla. In the past 10 years, Apple is up 344%, while Nvidia is up 2,593% in the 5 years. And the 10-year rise is off the charts. Yep, these have been exceptional times for these exceptional companies. And I think that they're not only, I guess you should make the point, that these are not only tech companies, because Tesla is not necessarily a tech company, but I would say all these businesses are what we call price inelastic businesses, meaning that most of us use their products on a regular basis. And as prices go up, we keep on using their products. And that's part of the reason why their share price reflects this. Sure, Tesla is not tech, but it still is price elastic. Its challenge probably is that China is producing many EV rivals, but Tesla's share price has gone up 1,488% over the past 5 years. Now, think of Apple users who use Microsoft for emails every day. Go to Facebook, Meta, using Google, Alphabet, plus from Amazon, benefit from AI-driven products driven by Nvidia chips, and possibly drive to work in a Tesla. People with non-Macs undoubtedly live the same lives with these magnificent 7 companies. This is an exceptional time for exceptional businesses, and they've created an exceptionally rising stock market right across the world. Of course, there will be a market crash one day, remembering the last one was only 2 years ago, starting in October 2022. As interest rates rose, that killed that market, and the same sort of thing will probably happen again. US bull markets, by the way, have an average life of 3.8 years, and that's since 1932. But there's another statistical take on the US bull market that came from Forbes.com. It says since 1957, the average bull market has lasted nearly 5 years and generated an average S&P 500 return of more than 169%. Bull markets have historically performed best during the first year, following the previous bear market bottom, averaging about 41.8%. The table I'm showing you now shows you how long these bear markets have lasted. And it does pretty well show that the current one is very young, not all that long in the tooth in time-wise. So given this, is it fair to say that this bull market is not historically old, but the gains have been historically significant? So this could be a short bull market like the one in 1966, 68. On what Buffett's up to, he's confessed he doesn't really have an accurate crystal ball when it comes to bull markets and when they end. But the AFR looked at Bloomberg's Nir Kassar's knowledge of Buffett, and this is what he revealed. The record shows Buffett consistently raising Berkshire's cash allocation as stock valuations rise during a boom and expected returns consequently decline, and drawing down cash as opportunities arise. That's what Buffett does. It also confirms that Buffett has little talent for market timing, and he readily admits this. What we've got is a really big boom, and so Buffett is building up cash. This is what he does, and so it doesn't mean he thinks the boom will end soon, but he's taking profit ahead of at least a pullback or maybe a crash. And therefore, the next question has to be, is a crash imminent? I think a pullback is on the cards, and these stories about inflation remaining sticky in the US and the Fed delaying or halting rate cuts would trigger a sell-off of stocks. Also, come when December reporting season ends and we see what happens in early 2026, this could also be a trigger for a sell-off in the market. But on the other hand, the outlook statements from US companies could be all really glowing because of Trump promising lower taxes and less deregulation. So it's not there's not an easy argument for a crash. There's a believable argument for a pullback, which many of us think will be a buying opportunity. On the plus side, Wells Fargo's investment team has been grabbing the headlines lately with an S&P 500 call of 6,600 by the end of 2025. Now, that implies a 10.5% gain, which incidentally has been a kind of a guess I've been sharing with my financial planning clients and the subscribers to the Switzer report. And I think, we've seen 2 huge years, but another reasonable year, a 10% gain, makes a lot of sense. So this is the argument that I think has a lot of credibility. A pullback is on the cards. It will be, I think, a buying opportunity. I think a lot more negatives have to come along before we see this market really sell off big time. Fears around inflation remaining higher than expected and interest rate cuts being taken off the table, that could really hurt the market. And that's something we're going to have to look out for. But at the moment, that is not an argument anyone is pushing with any credibility. I think the bottom line is in 2025, there are gains ahead, particularly because Trump is promising lower taxes and also deregulation moves. But on the other hand, we have to watch the implications of tariffs. And I don't think we have to worry about tariffs until probably the middle of 2025, when Trump really gets into his negotiations phase with both Europe and particularly China. That's when we might see a sell in May and go away year, which once again may well be another pullback rather than a crash, depending on what the agreements are, decisions made by the Trump administration on the subject of tariffs. So from my point of view, it's reasonable to remain long the market. If you want to take a bit of profit because you've done really well, that makes a lot of sense as well. But I wouldn't be getting too negative just because Buffett is increasing his cash holdings by double. He still has a very long exposure to the US stock market and to the sort of stocks he really likes. That's my story, and I'm sticking to it. That's the show for this week, and thanks for joining us. We'll be back next week with a new group of guests. I hope you can join us then. And remember, if you're interested in the Switzer report, go to switzerreport.com.au. I'd love you to become a subscriber. See you next Monday.